Hi you guys, I hope everyone's week is going well. Today we're going to keep chugging along with chapter 2. So this is the last practice problem that we did together if you watched the part 1 recording for chapter 2. And I also have this document listed for you guys to follow along if you would like. I'll show you where to access it. So if you go to the chapter 2 practice problems, you are free to follow along with this Excel doc. And notice that this says student copy, so it's blank for you to follow along with the video. So that's there if you would like to use it. So yeah, today we're just going to go through so many different practice problems. Right, we already learned about debits and credits. Now it's really just, it comes down to practice. That's the best way to understand this material. So we did this last time. Let's move on to slide 17. So question 3, it says on March 31st, 2019, a company performs $200,000 worth of services for a client, and then client pays the company $200,000 on that date. The company has no further obligations to the client once the services have been performed. Record the transaction using T accounts. So I'm going to open up our Google Doc. And here's question 3. You have the problem right in front of you. So we need to record this transaction using T accounts. And notice that anytime we record a transaction, 2 accounts will be impacted. So we have 2 T accounts. So what do we think? Company performs $200,000 worth of services and the client pays them that $200,000 on that date. So the 2 accounts that are going to be impacted, right, are cash account and our revenue account, or you might see it as service revenue. Cash, this is an asset. It is going up for the business, right? If we want to increase an asset, we debit that account. So $200,000. To offset this debit, right, we need a corresponding credit, which this checks out, right? Revenue. Here, we can go back to this. Let's see where it is. If we follow along with this, right, we have our debits and our credits column. Assets increase with the debit. Liabilities and owner's equity increase with the credit. Expenses are increased with a debit. And revenues, right, that's what we have, are increased with a credit. So the corresponding credit is over here. That's question 3. Again, if you want kind of a more detailed walkthrough, if you go to the PowerPoint, there's a detailed walkthrough YouTube video that you can follow along with. But let's keep on going. Let's try question 4. Question 4. On June 15th, 2019, a company receives consulting services from a vendor. The company receives an invoice from the vendor for $50,000 on June 15th, 2019, and immediately pays the vendor for the services. The vendor has no further obligations to the company once the services have been performed. Record the transaction using T accounts. So again, we're going to need 2 T accounts. For every transaction, 2 accounts are impacted. So, let's see, which 2 accounts? Well, the company's going to be paying, right? Cash is going out the door. And I'm going to copy this over just so we can have this again. Right? If we were to increase an asset, which cash is, we would debit it. And the flip side, to decrease an asset, we would have to do the only other option, which is a credit. So we are going to credit our cash account for $50,000. The corresponding account is, you could just call it expense, but it's better to be a little bit more specific. So this is known as the consulting expense. And to increase an expense, we have to debit that account. So we are going to debit it for that corresponding $50,000. So hopefully question 3 and question 4 are making sense. Again, if you need a more detailed explanation, watch these, click on these links on the PowerPoint. Okay, let's try our next one. Okay, so we've got, this comes from our ebook. And we're learning about T counts and analytical tool. So the following narratives describe transactions impacting cash, accounts receivable, accounts payable, revenues, and selected expense accounts. So this problem's pretty nice. They even tell us which accounts we're going to need to use. Using T accounts, analyze this activity and determine the ending balance for accounts receivable and accounts payable. And they also tell us at the beginning of the period, accounts receivable is this much and accounts payable is this much. And we have this much in cash. So before we even dive into the problem, let's set up the given information. Similar to a math class, anytime that they give you information, that should be your very first step. So let's see, we have a cash account they told us. They told us we're going to have an accounts receivable account. I could spell receivable. We are going to have an accounts payable. We are going to have revenues. And then let's put our expenses down here. We'll have a supplies expense, they tell us. Well, they don't specifically say supplies, but I'm kind of giving you a hint. We're going to have a supplies expense, and we're going to have a utilities expense. So let's walk through this together. Before we do that, back up. We got to fill in our beginning amounts. So at the beginning of the period, accounts receivable totaled this amount. So accounts receivable, that's an asset. Remember, assets typically have debit balances. So here's our beginning amount of $54,300. And off to the side, I'm just going to write BEG for beginning. That's our beginning amount. So they gave us that, and they said at the beginning of the period, accounts receivable was that, while accounts payable totaled $31,275. So let's go to accounts payable. Accounts payable is a liability, right? Anytime you hear the word payable, you should be thinking, oh, this is an obligation that the company has or owes. So it has a typical credit balance. So our beginning amount is $31,275. And off to the side, I'm going to write beginning. And they also tell us the company started the period with $85,000 in cash. Cash is an asset. Assets typically have a debit balance. So $85,000. That's our beginning amount. Put that over here. Okay, so now that we've prepped this, now we're ready to dive in. So transaction number 1. Services were provided to customers for cash in the amount of $15,230. Okay, well, we've got two accounts that are going to be impacted by this transaction. Cash goes up, right? The company's receiving cash, so let's put that in there, of $15,230. And I'm going to write a little 1 next to this just so we know, hey, this relates to transaction number 1. The other account that's impacted by this is revenues, right? Services were provided to customer for cash in the amount of this number. Therefore, we're able to recognize that revenue. The company's able to recognize that revenue. Revenue, right, typically has a credit balance. If we want to increase a revenue account, I'll flip back here. If we want to increase a revenue account, we need to credit it. And I'll copy this over just so you have it in front of you if that's easier. We'll put it down here. So revenue gets increased with a credit. So, and I'm just going to reference this exact amount so I don't have to type it in again. And again, this relates to transaction number 1. So hopefully so far so good. Let's do transaction 2. Supplies were purchased and used. This purchase occurred on account in the amount of $2,400. So on account, when you hear that, you should be thinking, oh, we haven't actually paid cash for it, right? We just kind of maybe swiped our credit card. This tells you on account should tell you, hey, I'm dealing with accounts payable. Accounts payable, right? That's a liability, typically has a credit balance. So that's $2,400, and this relates to transaction 2. That's the first part. But what else does it say? It says supplies were purchased. That accounts for the purchase. And they were used. Because they were used, we're able to expense them. That's why we're going to tap into this account. Right? Supplies expense. In order to increase an expense or to record an expense, we need to debit that account. So this is going to be equal to 2,400. And again, this relates to transaction 2. Let's try number 3. Collections of outstanding receivables occurred in the amount of 19,410. So what does this mean? The company had basically all this money that was owed to them, right? They have this beginning accounts receivable amount. People owed them money. And now they have actually paid them, right? They collected these outstanding receivables. They received the cash for it. So our cash account is going to go up by this amount. Right? We actually got the cash. The flip side of this is we need to reduce our accounts receivable because, right, we've been paid those amounts. So we need to actually reduce our accounts receivable. To reduce an asset, you're going to credit it. So 19,410, and that relates to transaction number 3. Notice that we have one asset that is going up, right? Cash is increasing. And we have another asset that's decreasing. Accounts receivable is going down. Therefore, our total assets, they're remaining the same. It's just the type of asset has changed. Let's try number 4. Utilities cost in the amount of 763 were incurred and paid in cash. Right away, we know that our cash balance is going down, right? They're paying your utilities expense. Cash is an asset. To increase an asset, we would debit it. The flip side, to decrease it, we would credit it. So 763. This relates to transaction number 4. And utility costs were incurred and paid. So our utilities expense, we need to record an expense. Therefore, we're going to debit the expense account of utilities. So this equals 763. And again, this relates to transaction number 4. Let's try transaction number 5. Payments on outstanding accounts payable were made for 23,900. So what this is saying is the company, right? They have these outstanding obligations. They still need to pay possibly creditors or vendors or any other person that they owe money to. Well, they actually made payments on those accounts. So we need to decrease our cash for 23,900. They actually paid them. And this relates to transaction number 5. Sorry. Then, right, we've actually paid them. Well, we need to reduce our accounts payable balance because we don't have this much due anymore. We've paid some of them off. So accounts payable is a liability, which is normally increased by a credit. If we want to decrease an accounts payable, we would just do the opposite, which is a debit. So we are going to decrease our accounts payable by 23,900. And this relates to transaction number 5. Let's insert one column to the left. Put this guy over here. And this relates to transaction number 5. Okay, last one. Services were provided to customers on account in the amount of 48,654. There's that word again, on account. So services were provided to customers on account. So we've actually rendered the services, so let's increase our revenues. In order to increase a revenue, you credit the account. So this is 48,654. This relates to transaction number 6. And services were provided to customers on account. Right? That means customers owe the company in the future. Therefore, this is going to increase our accounts receivable balance, or T account. So 48,654. And again, this relates to transaction number 6. So let's read the problem again. What are we needing to do? Use T accounts to analyze this activity and determine the ending balances for accounts receivable and accounts payable. So let's figure out the ending balance for these two T accounts. And we'll do a top order, make it a little bit better to see. Okay, so how do we figure out the ending balance in an account? It's really simple. All you need to do is sum up your total debits and sum up your total credits and then take the difference. So let's do that. Our total debits for accounts receivable, we have 54,300 plus 48,654. Let's put a plus sign, not an equal sign. There we go, add them up. Those are our total debits. And our total credits, we just have one account or one amount, so it's just that. Then the last step is to take the difference, right? Clearly we have more debits than credits. Therefore, we're going to have an ending debit balance. So we're going to do this minus this. And this will give us, I'll bold it, that is our ending accounts receivable balance. Let's do the same thing for accounts payable, right? Let's draw our line so we can kind of see where our calculations are starting. What's our total debits? It's just one amount, so that's pretty easy. And here's total credits. We're going to take this plus this. Clearly, we have a greater amount in the credit column, so we're going to end up with total credit balance. To figure that out, all we need to do is our credits minus our debits. And I'll bold that. That is our ending accounts payable amount. So a couple of notes on this problem. If it is easier for you to handwrite, if you do not feel comfortable in Excel or Google Sheets, you are more than welcome to handwrite your problems. You do not need to use Excel for this. Okay, so that was B-02.08. Just jump back to the PowerPoint. Couple of things to note, right? When we are creating the basic financial statements, there's several steps that we need to follow. Right? The very first is to record all transactions into T accounts. That's what we did in that previous problem. We also need to prepare a trial balance. So let's talk about that. I believe in your homework, let's open up your homework. Homework. Jeez, okay. Once this loads. So this homework problem, you're going to watch a step-by-step YouTube video. So the answers are right there in front of you as long as you watch the video. You are going to be creating an unadjusted trial balance. The question is also going to show you how accounts get closed to retained earnings. That was not included in part of your reading, but it's a good idea to at least become familiar with the process. This homework problem, no point should be docked against you. As long as you watch the video, you should be fine. In our ebook, we're going to be covering this in chapter 4, but it's important to just kind of get a big picture of the overall idea. So keep that in mind. So record all transactions into T accounts, prepare a trial balance, then you will prepare an income statement, prepare the statement of retained earnings, and here, right, close out all temporary accounts, revenues, expenses, dividends. These will get closed out to retained earnings. So no worries if this seems a little bit confusing at this point in time when you do your homework. Once we get to chapter 4, this will make a lot more sense. Again, those homework problems, they should be super easy. All you have to do is watch the video and answer basically the answers are in the video. So this is just kind of big picture, kind of where we're starting and where we're going to go. Next, prepare a post-closing trial balance and then prepare a balance sheet. So just keep this in mind. Let's try this one. We've got a practice problem down here that deals with dividends, but let's talk about dividends. Remember, dividends are basically what a company will pay to shareholders. So they're a way that a company has of giving back to its shareholders by distributing net income generated by the company. It is not mandatory that a company pays out dividends, right? It's the board of directors' decisions. They get to choose. How do dividends impact the financial statements? They are a reduction to retained earnings. So keep that in mind. You don't need to know this too much. It's good information, but you won't be tested on it. Yeah, so the participants or the shareholders that receive these dividends, those are considered taxable income to the shareholders. Not super important for this class, but just a good idea to know. Another important thing to note, dividends are not part of the income statement. So technically they are not considered an expense. Rather, dividends reduce owners' equity. They reduce retained earnings. And you will see definitely in your homework and or potentially in your homework and definitely in chapter 4 that dividends are a temporary account. They get closed out to retained earnings at the end of the period. That is what we mean by temporary accounts. All of these different expense accounts or revenue accounts, they will get closed out to retained earnings at the end of the period. No worries if that doesn't make any sense right now. Once we get to chapter 4, we're going to really dive into the details. But let's just examine how would we record, the T account dealing with a dividend transaction. So let's go back up here and go to question 6. So example, a company declared and paid a dividend to its shareholders on December 15th, 2019 of $17,000. Prepare the transaction using T accounts. Okay, so clearly cash is going to be impacted, right? Cash is coming out of the company. Cash is an asset. Copy this over again. Cash is an asset. To increase an asset, we debit it. Therefore, to decrease an asset, we must credit it. So we're going to decrease cash by $17,000. It has to have an offsetting account, right? Every transaction impacts 2 accounts. So there is a T account called dividends. And like I said earlier, it is technically not an expense, right? It reduces owner's equity, or let's call it owner's equity. Therefore, when we use a T account to create dividend transactions, you can almost think about it as an expense. It's technically not an expense because it doesn't hit the income statement, but it reduces owner's equity. Therefore, it's going to behave the opposite of owner's equity. So if we increase owner's equity with a credit, then we, are going to increase a dividend with a debit. The easiest way I think to think about it is when you see dividends, treat it as an expense. Technically it is not, but go ahead and just treat it as an expense when you are using T accounts. So therefore, we are going to debit our dividends for $17,000. Okay. So far, in this chapter, we really have just been dealing with debits and credits. How do you use T accounts, right? How do we record transactions using T accounts? Well, we can take this one step further, and you're going to see why T accounts are so helpful. They basically are leading us exactly to figure out how to write journal entries or record journal entries. So what is a journal entry? A journal entry is shorthand for recording a financial transaction in an accounting system. We can make a journal entry from our T accounts. That's why it's so important to get a really strong understanding of T accounts. Once you have that down, a journal entry is super easy. All you have to do when you're creating a journal entry is add a date and a description. So let's try these next 2 questions. So we've got question 7. On June 15th, 2019, a company receives consulting services from a vendor. The company receives an invoice from the vendor for $50,000 on June 15th and immediately pays the vendor for the services. The vendor has no further obligations to the company once the services have been performed. So what do we need to do? We need to record the transaction into T accounts and then prepare the journal entry. So let's go ahead and do this. This problem should seem somewhat familiar. So let's start with cash. right? Cash is leaving the company. Oops, not cash. Cash is leaving the company. If cash is going out, right, we're reducing an asset, we are going to credit it for $50,000. The corresponding account is an expense, specifically this consulting expense. But feel free to use any title that makes sense to you. So if this is a credit, we have to have an offsetting debit. And again, this is an expense. To increase an expense, you debit the account. So that should be pretty straightforward from what we've already learned. Now we have to record the journal entry. So let's come down here, journal entry. So how this works is we're going to have a debit, and then we're going to have a credit. And the credit gets kind of indented. So our debit, right? Which account are we debiting? We are debiting consulting services expense. What account are we crediting? Cash. And then all you have to do is put the amount. Well, our debit, right, is $50,000. So I'm going to leave some spaces. And our credit, right, it's cash, the same amount. And this needs to go past, right, because this credit is indented a little bit. Typically, the corresponding amount needs to also go past this debit amount. So this is the format of a journal entry. The other thing that's really important is to include the date. Oops, that doesn't, let's put them over here. Insert this really fast so you can see it. And our date for this one is June 15th, 2019. Make sure that date gets included. So you need a date, and then you also need a description. Right? Think about it. If you are the bookkeeper or the accountant, right, you have all these transactions, it's pretty easy to get confused. What does this relate to? Right? Maybe you have a bunch of different consultants. Maybe you need to put down, oh, this goes specifically from, vendor ABC. So it's really important to include a description. And so let's put to record consulting services received from a vendor. Okay, so hopefully you guys can see where this T account, once you have this part down, creating a journal entry is very easy. The other thing that I want to say is, let's copy this down here. Typically, you won't ever see the word debit written out. What you'll usually see is a DR, or you will see, right, you're not typically going to see credit, you're typically going to see CR with a period. So this stands for debit, this stands for credit. So again, journal entries, it's basically your T account with the date tacked on and a description. And I'll bold this just so you remember, these are the two things you have to add. Also, it's important that the debit always comes first, and the credit is second and indented. So the title of the account is indented along with the actual number. Let's try question 8. On December 31st, 2020, a company purchased equipment valued at $100,000. The company makes a 20% cash down payment, and the remaining balance will be placed on a note. Prepare the T accounts and journal entry in the appropriate form for the transaction. Okay, so what accounts are going to be impacted by this? So we definitely have an equipment account that needs to be established, right? Equipment is an asset. To increase an asset, we debit the account. So $100,000. And what else? We're paying. Cash is going out, right? The company makes a 20% cash down payment. So what's 20% of 100,000? That's just simply 20,000. And cash is going down. It's decreasing. Therefore, we're going to credit the amount. There we go. Notice, though, that our debits and our credits do not equal each other. There's an important last part that we forgot. The remaining balance will be placed on a note. So let's copy this and not cash. We'll call it note payable. So, right, this is a liability. To increase a liability, we have a credit balance, or we credit the account. So we bought $100,000. This equipment is $100,000. We paid 20% of it, $20,000. So the remaining $80,000 is going to go on a note. That's a future obligation for the company. So now let's record the journal entry for this. JE stands for journal entry. So we are going to debit our equipment. Now let's put some spaces in. I guess we could just use a different cell. That's probably easier. For $100,000. And then let's put our credit right here. Our credit, well, we have one credit for cash. We'll put it right here. That's $20,000. And we have another credit of a note payable. And that's for $80,000. Notice that our total debits sums up to our total credits. That has to be true for every single transaction that you record. If your debits and your credits do not equal each other, then you know you made a mistake. You need to go back. So what else do we need? We need the date. And the date is December 31st, 2020. And we also need a description. So let's call this one to record purchase of equipment. And right, so for class purposes, this doesn't need to be too specific. But let's say potentially, you're the bookkeeper, the accountant, and you're dealing with lots of pieces of equipment. You might want to be more specific and explain exactly what this piece of equipment is. But hopefully that makes sense, and hopefully you can see the importance of, once you have T accounts down, you basically have journal entries down as well. I think, yeah, all we have is one last practice problem, and then that's it for today. So let's do this last one. Try to make this a little bit bigger. And I'm going to copy this over again, just so we have it. I'll put it down here. Okay, so let's read the problem. It says, Mo Lambert formed a corporation to provide concrete construction work. His jobs typically involve building parking lots, drives, and foundations. Mo provided the following information about transactions occurring during the first month of operation. Evaluate the transactions and prepare journal entries for this activity. Okay, so let's prepare our journal entries. Okay, so we've got our first one. And I'm going to just number these off to the side so it's a little bit easier. So we've got one. Okay, so we've got all of our transactions and the corresponding number. So what I recommend, even though this suggests, hey, just, jump straight to the journal entries, I still encourage you to first use the T accounts. So Mo Lambert invested $10,000 cash in the capital stock of the newly formed corporation. So we've got cash, and let's put common stock over here. And we might need some more T accounts, so I'm going to copy some over. Okay. So Mo invested $10,000 cash in the capital stock of the newly formed corporation. So cash went up for $10,000 for the company. That's an asset, right? To increase an asset, you debit the account. This relates to transaction number 1. The offsetting transaction, right, is common stock for $10,000. Common stock falls under owner's equity. Therefore, to increase common stock, we have to credit the account. This relates to transaction number 1. Okay, so how about right away we just come over here and write the journal entry? One less thing to worry about. So, and the date that this took place, January 2nd. So we've got our journal entries. Let's tack them on over here. So we're going to debit cash. We are going to credit common stock. Our cash amount is $10,000. Our common stock amount, same thing, $10,000. Our date, we'll call it 1, 2 / they don't give us a specific year. And then our description. Issued stock to Mo Lambert for cash. So that's our first journal entry using the T account. Okay, let's do the next one. Purchased equipment on account for $7,500. Well, equipment is going to come up. Or sorry, is going to increase. Equipment is an asset. To increase an asset, you debit the account. So $7,500. This relates to transaction number 2. And they purchase it on account. There's that key word. Therefore, you know that they are going to be paying for this equipment with potentially a credit card, right? They haven't actually paid cash they haven't paid with cash yet. So this is a future obligation. Therefore, this is a liability. To increase a liability, we credit the account. So this is $7,500. And this relates to transaction number 2. So let's come over here and fill out the journal entry. And what was our date? January 4th. So let's put that in here. So we've got January 4th of X5. We are going to debit equipment. We are going to credit, and I'm just going to abbreviate it, accounts payable. And the amount is $7,500, $7,500. And what is our description? Purchased equipment on account. There we go. Let's try the next one. Received $15,000 from customers for services rendered. So cash went up, right? Cash increased. Therefore, we're going to debit our cash account. This relates to transaction number 3. What's the offsetting? We also received revenue that we can recognize now, right? Services were rendered. Therefore, we're able to recognize that revenue. So cash went up by $15,000. We can also increase our revenue account, right? To increase a revenue account, you credit the account. And this relates to transaction number 3. This took place on January 12th. So let's go do our journal entry. So January 12th of X5. We are going to debit our cash. We are going to credit our revenue. The amount is $15,000 for each. And our description, provided services to customers for cash. Okay, next one. Let's try 4. Received a bill. Received. Okay. Received a bill for construction supplies used in the amount of $2,000. So our supplies expense account needs to be established. And while I have some of these, let's make some extras. Oh, we got some more down here too. Okay. So received a bill for construction supplies used in the amount of $2,000. So supplies expense. We'll do this one down here. Supplies expense. This is an expense. To increase an expense, you have to debit the account. This relates to transaction number 4. The offsetting one, right? Supplies expense. We go back over here. Received a bill for construction supplies used. Have we paid it yet? No, it's a future obligation. Therefore, this is accounts payable of $2,000. Relates to transaction number 4. So let's come back up here. Let's do our journal entry. Transaction number 4 took place on January 15th. So we are going to debit supplies expense. We are going to credit accounts payable in the amount of $2,000. what are we missing? We're missing a description. And this is this is received bill for cost of supplies. Okay, let's do number 5. Provided $3,200 of services on account. So revenue goes up, right? They provided those services. To increase a revenue account, you credit the T account. So this is $3,200. This relates to transaction number 5. And they provided these services on account, right? That means that they are going to actually receive cash for this in the future. So this impacts our accounts receivable. I'll put accounts receivable down here. And to increase an asset, we debit the account. This relates to transaction number 5. So to come back over here, let's fill out our journal entry. This took place on January 18th. And we are going to debit accounts receivable. There's kind of the shorthand. And we are going to credit revenue. The amount is $3,200. And we need a description. Our description is provided services to customers on account. Let's keep on going. There's quite a few of these. Number 6. Paid employees $2,300 for wages earned. So, we paid employees. Cash went out. We need to decrease our cash account. To decrease it, we credit the account. This relates to transaction number 6. And we also need to establish an expense. Paid employees. We need to create this wage expense. Just going to put it down here. So wage expense. Wage expense, right? To increase an expense, you need to debit it for $2,300. Gosh, I keep doing that. $2,300, and this relates to transaction number 6. So come over here. Let's do our journal entry. We have this occurred on the 20th of January. We are going to debit wage expense. We are going to credit cash in the amount of $2,300. Should say cash. And we need a description. Paid wages of employees. There we go. Let's try the next one. This relates to transaction 7. Collected 60% of the amount due for the work provided in January 18th. So before we keep going, important thing to note. This is why it's really important. Either you include the date right next to the T account that relates to that transaction, or you include the number. Because this is very common, especially in accounting 1A, where you're going to have to go back and look at a previous amount. So, right, January 18th, we can see that's transaction number 5. So it's really easiest to see, well, that's the revenue here, and there's the accounts receivable right there. So it'll make the other problems easier. So let's keep on going. Collected 60% of the amount due for the work provided on January 18th. So, what was the amount due? $3,200. What's 60% of $3,200? We can do this by doing 0.6 or 60% times $3,200. That's $1,920. That means this amount was actually collected. So it's not a part of accounts receivable anymore. We don't have that amount coming to us. It's already been received, right? So how are we going to record this? Well, we need to increase our cash amount for $19,200. I'm going to slide this guy in here. This relates to transaction number 7. And our accounts receivable is going to be reduced by this $19,190. This relates to transaction number 7. let's go ahead and do our journal entry for this one. So this occurred on January 22nd. We debited cash. We credited accounts receivable for $19.20. Remember, this is 60% of that previous amount of $3,200. So let's write our journal entry. Collected 60% of the amount due from the transaction on January 18th. And then just as a reminder, we can do 3,200 times 60% equals 1920. Just to kind of jog our memory. Okay. That was transaction 7. Let's do 8. Paid 40% of the amount due on the equipment purchased on January 4th. So let's look at our equipment. January 4th. Purchased equipment on account for $7,500. So that means, right, cash went out. We actually paid 40% of the amount due. So what is 40%? Let's do it up here. What is 40% of $7,500? That's $3,000. So cash went down $3,000. This relates to transaction 7. I'm sorry, this is transaction 8. Cash went down $3,000. But accounts receivable also went down $3,000, right? We no longer owe this amount. We actually made a payment. So $3,000, this relates to transaction number 8. So let's go do our journal entry for that problem. This occurred on January 23rd. We are going to debit our accounts payable, right? We're reducing it. And we're going to credit our cash. We're also reducing our cash for $3,000. And we are going to write paid 40% of the amount due for the transaction on January 4th. And just to remind ourselves, this was the 7,500 times 0.4. Okay, almost there. Purchased and immediately used construction supplies for cash in the amount of $600. So this one's pretty straightforward. We don't have to go back in the past. So purchased and immediately used construction supplies for cash. So cash went down by $600. This relates to transaction 9. And we have this supplies expense account that needs to be established. So let's write that right here. Oh, we already have supplies expense. Perfect. So supplies expense, how much should we spend? 6,000? Oh, only 600. $600. This supplies expense, we need to increase our expense account, therefore we debit it. This relates to transaction 9. Let's go over and do our journal entry. So this occurred on January 25th. We are going to debit our supplies expense. We are going to credit our cash. This is 600. This is 600. And let's write our description. Paid for supplies used. Last one, we're almost there. The company paid Mo Lambert a $1,500 dividend. So cash went out. Therefore, to reduce our cash, we credit it. This relates to transaction number 10. And we need to create a dividend account. Remember, dividends, it's technically not an expense, right? It's a reduction to owner's equity. However, in terms of journal entries and T accounts, you could think about dividend as an expense. Therefore, to record an expense, we debit the account. And this is for $1,500 relating to transaction number 10. So last journal entry, we're almost there. So this occurred on January 31st. We are going to debit dividends, we are going to credit cash. This is $1,500. Oops, $1,500. And our description is paid dividend to Mo Lambert. So this problem, hopefully you can see where, as long as you know how to record them in T accounts, the journal entries really not that bad. Also, if you are watching this recording, just know that you can always pause and record if I'm going too fast, and write it down, especially if you're handwriting. It might take you a little bit longer, so feel free to pause the video and then write out your answers. But those are all the practice problems I want to go over. I just want to reiterate again, right? These homework problems, I believe it's homework A, and I believe the next one as well. Nope, B is fine. I think it's C. Yeah, so homework A, 2A, and 2C, you're going to be watching this step-by-step YouTube video. These videos discuss closing accounts to retained earnings. We're going to be covering this together in Chapter 4. This is kind of just to give you a sneak peek on the overall process. That way, this slide, you'll kind of understand what's happening. How do we actually create these basic financial statements? There are several steps that we need to go through. So far in this chapter, we've really been focusing on putting the transactions into T accounts and then writing journal entries from those accounts. So I hope you guys have a great rest of your day. If you have any questions, please feel free to ask me, email me, come to office hours, and I will see you guys next week. Thanks.